Every investment carries some degree of risk. That's the nature of the game. But some investments are inherently riskier than others. Stocks, for instance, offer the potential for high returns, but they can also be volatile. Bonds, on the other hand, are generally considered more conservative. Think of it like this. Stocks are like the sprinters of the investment world. They can deliver quick bursts of growth, but they can also tire out quickly. Bonds, on the other hand, are the marathon runners. They provide steady, reliable returns over the long haul. Finding the right balance between risk and reward is crucial. It's about aligning your investment choices with your risk tolerance, your ability to stomach ups and downs in the market. If you're younger and have a longer time horizon, you might be more comfortable with a higher risk, higher reward approach. But as you get closer to retirement, preserving your capital and ensuring a steady income stream becomes increasingly important. That's where bonds come in. Bonds are often seen as the anchor of a balanced portfolio. They provide stability, income, and a measure of protection against market volatility. But what exactly are bonds? How do they work? And why are they so important for investors of all ages and risk tolerances? In the following sections, we'll demystify the world of bonds, breaking down the basics, exploring the different types of bonds available, and discussing how they can play a vital role in helping you achieve your financial goals. Whether you're a seasoned investor or just starting out, understanding bonds is essential for creating a portfolio that can stand the test of time. Let's face it, the word bonds doesn't exactly scream excitement. It sounds kind of, well, boring. But trust me, bonds are anything but boring once you understand how they work and the benefits they can bring to your portfolio. At their core, bonds are really quite simple. When you buy a bond, you're essentially lending money. You can lend to the government, that's a government bond, or you can lend to a company, that's a corporate bond. In exchange for your loan, the borrower, whether it's the government or a company, promises to make regular interest payments to you. These payments are usually made semi-annually and are called coupon payments. And here's the good part. On the maturity date of the bond, you get your original principal back. It's like getting a loan repaid with interest. Not all bonds are created equal. Government bonds, corporate bonds, and municipal bonds each have unique characteristics. Government bonds are issued by the government and are considered low-risk investments. They offer stability and are backed by the full faith and credit of the issuing government. For example, U.S. Treasury bonds have historically low default rates. Corporate bonds are issued by companies and typically offer higher yields than government bonds. However, they come with higher risk, as the issuing company's financial health can affect bond performance. For instance, high-yield or junk bonds offer higher returns, but come with greater risk. Municipal bonds are issued by local governments to fund public projects like schools and infrastructure. One key benefit is their tax-exempt status, which can be attractive to investors in higher tax brackets. However, they can be subject to local economic conditions. Understanding the differences, benefits, and risks of each bond type is crucial for building a balanced portfolio. Diversifying across government, corporate, and municipal bonds can help mitigate risk and optimize returns. Navigating the bond market can feel like learning a new language. But don't worry, once you grasp a few key terms, you'll be speaking bond lingo in no time. We've already touched on coupon rate. That's the fixed interest rate the bond pays you. Then there's maturity date. That's the date you get your principal back. But what about yield? Yield is a bit trickier. It reflects the annual return you can expect from a bond, taking into account its current price and coupon payments. And then there's credit rating. Think of it like a report card for bond issuers. Rating agencies like Standard & Poor's and Moody's assess the creditworthiness of bond issuers, giving them a grade that reflects their ability to repay their debts. A high credit rating means the issuer is considered low risk, while a low credit rating signals higher risk. Another important term is bond price. Bond prices and interest rates have an inverse relationship. When interest rates rise, bond prices fall, and vice versa. Understanding this relationship can help you make better investment decisions. Lastly, let's talk about duration. Duration measures a bond's sensitivity to interest rate changes. The longer the duration, the more sensitive the bond is to interest rate fluctuations. By understanding these key terms, you'll be better equipped to navigate the bond market and build a balanced portfolio. Remember, knowledge is power. The more you know, the better your investment decisions will be. Credit ratings. Gauging the trustworthiness of bonds. Credit ratings are like a financial health check for bond issuers. They offer crucial information about the risk involved in lending money. Would you lend money to a friend with a solid credit history or one who's always behind on their bills? Credit rating agencies act as financial detectives, digging deep into financial statements. They assign a letter grade, from AA to D. Understanding credit ratings is essential for making informed bond investments. These ratings help investors gauge the likelihood of getting their money back. Higher-rated bonds are considered safer, but often offer lower returns. Lower-rated bonds might offer higher returns but come with increased risk. Diversifying your bond investments can help balance risk and reward. Always consider credit ratings as part of your overall investment strategy. Now that we've demystified the world of bonds, let's talk about why they deserve a place in your portfolio. One of the most compelling reasons is the allure of predictability. Unlike stocks, which can be as unpredictable as a roller coaster ride, bonds offer a sense of stability, a steady hand in the often turbulent world of investing. Remember those coupon payments we talked about? Those regular interest payments are like clockwork. Knowing you have that steady stream of income coming in can be incredibly reassuring, especially for income-seeking investors and retirees living on a fixed income. Imagine this: you're retired, enjoying your golden years, and you need a reliable source of income to cover your living expenses. Bonds can provide that peace of mind, that sense of financial security that allows you to sleep soundly at night. Remember that roller coaster we talked about earlier? Well, no one wants to be on a financial roller coaster all the time. That's where the power of diversification comes in. Diversification is the investment equivalent of not putting all your eggs in one basket. And bonds are like the sturdy, reliable basket that can help smooth out the ups and downs of the market. Think of it this way: stocks and bonds often move in different directions. When the stock market takes a tumble, bonds tend to hold their value better, acting as a buffer against losses. This is because bonds are less directly tied to the ups and downs of the economy. By diversifying your portfolio with bonds, you're essentially creating a smoother ride for yourself. You're reducing your overall risk, making your portfolio more resilient to market fluctuations. And that, my friends, is the beauty of diversification. As we journey through life, our investment goals evolve. When we're younger, we might be comfortable taking on more risk, seeking growth, and aiming for those home runs. But as we get closer to retirement or reach our later years, preserving what we've worked so hard for, our nest egg, becomes paramount. That's where bonds truly shine, as the guardians of your hard-earned savings. While no investment is entirely risk-free, bonds, especially high-quality government bonds, offer a greater degree of capital preservation compared to their more volatile counterparts, stocks. Remember, preserving capital isn't about avoiding risk altogether. It's about managing it wisely, choosing investments that align with your changing needs and risk tolerance. And bonds, with their relative stability and income-generating potential, can play a vital role in safeguarding your financial future. Tailoring bonds to your needs. How do you incorporate bonds into your portfolio? It starts with understanding your risk tolerance. Think of risk tolerance as your financial personality. Are you cautious or adventurous? Your risk tolerance determines your bond mix. For example, if you are risk-averse, you might prefer government bonds or high-quality corporate bonds. On the other hand, if you can handle more risk, you might consider high-yield bonds or emerging market bonds. Diversification is key. Mix different types of bonds to spread risk. Practical tips include regularly reviewing your bond portfolio and adjusting it as your financial situation or market conditions change. Find the balance that aligns with your goals. Remember, bonds can provide stability and income, but they should be tailored to fit your unique financial needs. Time horizon, your investment journey, and bond allocation. Your time horizon, the length of time you plan to invest, is crucial. Are you investing for a short-term goal, like a house down payment, or for the long haul, like retirement? Longer horizons allow for more aggressive investments. You have time to recover from downturns. Closer to your goal, preserving capital becomes key. Shift to a larger bond allocation for stability. Bonds provide regular income and reduce volatility. Consider different types of bonds: government, municipal, corporate. Assess bond ratings to understand risk. Bond duration impacts sensitivity to interest rates. A bond ladder can help manage interest rate risk. Diversify your bond holdings for a balanced portfolio. Asset allocation strategies. Building a portfolio that reflects your goals. How do risk tolerance and time horizon translate into a portfolio? Asset allocation is the strategic distribution of investments across asset classes. Think of it as the blueprint for your portfolio. It determines the risk and return profile of your investments. Subtract your age from 100 for stock allocation. The rest goes to bonds and cash. The optimal allocation depends on your circumstances and goals. Consider your financial objectives, whether it's growth, income, or preservation of capital. Regularly review and adjust your portfolio to stay aligned with your goals. A well-structured portfolio evolves with your changing needs and market conditions. The art of rebalancing, keeping your portfolio on track. Building a well-balanced portfolio is an ongoing process, not a one-time event. As markets fluctuate, your initial asset allocation can drift, exposing you to more or less risk than you intended. That's where rebalancing comes in, the process of periodically adjusting your portfolio to maintain your desired asset allocation. Think of rebalancing as staying true to your original investment plan. Over time, certain asset classes may outperform others, causing your portfolio to become overweighted in one area and underweighted in another. Rebalancing involves selling a portion of your holdings in the overweighted asset class and using those proceeds to buy more of the underweighted asset class. Rebalancing helps you maintain your desired risk level and ensures that your portfolio remains aligned with your long-term financial goals. It's like keeping your financial ship on course, even amidst the inevitable storms and choppy waters of the market. Seeking guidance, navigating the bond market with confidence. The world of bonds can seem complex, but don't let that intimidate you. Just like any financial decision, knowledge is power. Take the time to educate yourself about bonds, their different types, and how they can fit into your overall investment strategy. Remember, you don't have to go it alone. A financial advisor can be an invaluable resource, providing personalized guidance tailored to your unique needs and goals. They can help you determine the right bond allocation for your portfolio, select appropriate bond investments, and guide you through the complexities of the bond market. Building a well-balanced portfolio is an essential step towards achieving your financial dreams. By understanding the role of bonds and incorporating them strategically, you can create a portfolio that can weather the storms and help you reach your financial destination. We've explored the many advantages of bonds, from their stability to their income-generating potential. But like any investment, bonds come with their own set of considerations. One of the most significant factors to understand is the inverse relationship between interest rates and bond prices. Think of it like a seesaw. When interest rates go up, bond prices generally go down, and vice versa. Why is this? Well, imagine you buy a bond today with a 3% coupon rate. If interest rates later rise to 4%, your bond with the lower rate becomes less attractive to investors. To attract buyers, the price of your bond would likely need to decrease so that its yield becomes competitive with the higher rates available in the market. Conversely, if interest rates fall, your existing bond with its fixed rate becomes more valuable, potentially trading at a premium. This inverse relationship is crucial for bond investors to understand because it affects the market value of their investments. When interest rates are expected to rise, bond prices typically fall, which can impact the overall return on your bond investments. On the other hand, when interest rates are expected to decline, bond prices usually increase, enhancing the value of your bond holdings. Understanding these dynamics can help you make more informed decisions about when to buy or sell bonds. By keeping an eye on interest rate trends and market conditions, you can better manage your bond portfolio and optimize your returns. So, always consider the interest rate environment when investing in bonds to ensure you are making the most of your fixed income investments. While bonds are generally considered less risky than stocks, it's essential to remember that no investment is entirely without risk. One of the key risks associated with bonds is credit risk, the possibility that a bond issuer might default on its debt obligations. Remember those credit ratings we discussed earlier? They play a crucial role in assessing credit risk. High-rated bonds, such as those issued by the US government, are considered very safe, with a low probability of default. However, lower-rated bonds, often referred to as junk bonds, carry a higher risk of default. While junk bonds can offer higher potential returns, they also come with greater uncertainty. It's essential to carefully consider your risk tolerance and investment goals before investing in lower-rated bonds. Diversifying your bond holdings across different credit qualities can help mitigate credit risk within your portfolio. Inflation, the gradual increase in the prices of goods and services, can erode the purchasing power of your investments over time, including your bond holdings. Imagine this: you receive a 3% annual interest payment on your bond, but inflation is running at 4%. While you're receiving income, your purchasing power is actually diminishing. To combat inflation, consider incorporating bonds that offer some protection against rising prices. Treasury inflation-protected securities. TIPS, for example, are U.S. government bonds whose principal value adjusts with inflation. As inflation rises, the principal value of TIPS increases, providing a hedge against the erosion of your purchasing power. Other options include short-term bonds, which mature sooner and can be reinvested at potentially higher interest rates if inflation rises. Remember, maintaining a diversified bond portfolio with a mix of strategies can help mitigate the impact of inflation on your long-term investment goals. Types of bond investments. When it comes to building a bond portfolio, you have a wide array of choices, each with its own risk and return characteristics. Understanding the different types of bond investments can help you make informed decisions aligned with your financial goals. We've already talked about government bonds, corporate bonds, and municipal bonds. But within each of these categories, you'll find even more variety. For example, you can choose bonds based on their maturity date. Short-term bonds mature in a few years, while long-term bonds can have maturities of 10 years or more. You can also opt for bonds with different coupon structures, such as fixed-rate bonds, which pay a consistent interest rate throughout their term, or floating-rate bonds, whose interest payments adjust periodically based on prevailing market rates. Exploring these options with a financial advisor can help you create a bond portfolio that meets your specific needs. High-yield bonds, also known as junk bonds, offer higher interest rates, but come with increased risk. They can be a good option for investors looking for higher returns and willing to accept more risk. Treasury inflation, protected securities, or TIPS, are government bonds that help protect against inflation. Their principal value adjusts with inflation, making them a safe choice for preserving purchasing power. Convertible bonds can be converted into a predetermined number of the issuing company's shares. They offer the potential for capital appreciation along with fixed income. A bond ladder strategy involves purchasing bonds with different maturities. This can help manage interest rate risk and provide a steady stream of income. Diversifying your bond investments across different types and maturities can help balance risk and return, ensuring a more stable and resilient portfolio. Consulting with a financial advisor can provide personalized advice and help you build a balanced bond portfolio that aligns with your long-term financial objectives. Building a bond portfolio isn't about simply buying a random assortment of bonds. It requires a strategic approach that considers your risk tolerance, time horizon, and investment goals. One effective strategy is laddering, which involves investing in bonds with varying maturity dates. Imagine a ladder with each rung representing a different bond maturity. As each bond matures, you reinvest the proceeds in a new bond with a longer maturity, maintaining the ladder structure. Laddering can provide both liquidity, as shorter-term bonds mature more frequently, and potentially higher returns, as longer-term bonds often offer higher yields. Another approach is diversification, allocating your bond investments across different sectors, credit qualities, and geographic regions. This diversification helps reduce the impact of any single bond or bond issuer on your overall portfolio. Remember, a well-constructed bond portfolio is a key ingredient in a well-balanced financial plan. We've covered a lot of ground, haven't we? From the basics of bonds to the nuances of interest rates, credit risk, and inflation, we've delved into the world of fixed income and its vital role in a well-balanced portfolio. Remember those simple concepts we started with: bonds as loans, interest payments as income, and maturity dates as your principal's return. These fundamental principles underpin the entire bond market. Think back to the different types of bonds we explored: government bonds, corporate bonds, municipal bonds, each with its own risk and return profile. We talked about credit ratings, those financial report cards that help us assess the trustworthiness of bond issuers. And we discussed how factors like interest rates and inflation can impact bond prices and your purchasing power over time. Understanding these concepts is empowering. It allows you to make informed decisions about how bonds can best serve your individual needs and financial goals. Bonds aren't just for conservative investors or those nearing retirement. They're versatile instruments that can play a valuable role in portfolios across all ages and risk tolerances. Whether you're seeking a steady stream of income, aiming to preserve your capital, or looking to diversify your investments and reduce overall portfolio volatility, bonds have something to offer. Remember those asset allocation strategies we discussed: tailoring your portfolio's mix of stocks, bonds, and cash to align with your risk tolerance, time horizon, and investment goals. Bonds, with their relative stability and income-generating potential, often form the cornerstone of a well-balanced portfolio. But building a bond portfolio isn't a set-it-and-forget-it endeavor. It requires ongoing attention, periodic rebalancing to maintain your desired asset allocation, and a willingness to adapt to changing market conditions. The beauty of investing is that there's no one-size-fits-all approach. Your financial journey is unique, shaped by your individual circumstances, aspirations, and dreams. Bonds, like all investment tools, should be viewed as a means to an end, not the end itself. They're here to help you achieve your financial goals, whatever they may be. Whether you're saving for retirement, a down payment on a home, your children's education, or simply seeking financial security and peace of mind, bonds can be a valuable ally in your pursuit of financial well-being. Remember, knowledge is power. The more you understand about bonds and how they work, the better equipped you'll be to make informed decisions about your financial future. So, embrace the power of bonds, seek guidance when needed, and embark on your financial journey with confidence and clarity.